Good afternoon, Portland metro area, here in a sunny but chilly Portland, Oregon. I am Jennifer Tim. I'm a real estate wealth advisor licensed in both Oregon and California, and so honored to be back with you today and this week to bring you our midweek market brief, where smart money watches the market, and we're talking all things real estate. However, we are going to start out with our national outlook. So, our national economic snapshot. Labor market is cooling. Job openings dropped to 6.5 million, which is the lowest level since 2020. Private job growth slowed sharply. January hiring came in well below expectation. Layoff activity rising in some sectors, though overall unemployment remains moderate. And why do we care about the labor statistics when we're talking real estate? Well, because if we're going to be in a home, we've got to pay for it somehow. And for many of us, that means a mortgage. So what does that affordability look like? Mortgage rates are hovering in the low 6% range, relatively stable week over week. Inventory is up 10% year over year, but growth is slowing. And the national home price is mostly flat. Regional differences are definitely widening, and we'll look at some of that. Market balance nationally, but leverage varies significantly by region. As we know, real estate is all about local, and we will drill down into local. But first, we're going to look nationally for homeowners. National prices are steady, but local markets are moving differently. So it's really important to work with and stay in touch with your local real estate professionals so they can keep you updated on what's happening with potentially your largest asset that you own. Equity is holding in many areas, especially tight supply regions. Days on market are longer. Pricing right matters more than ever. More sellers are pricing strategically upfront. Fewer reach prices. Let's test the market. Doesn't work. Northeast and the Midwest have stronger seller leverage than the South. And your zip code is typically greater than the national headline. So in other words, your local market is probably performing a lot better than the national level. For buyers, more negotiation power is showing up in many southern markets. Price reductions are more common in buyer-friendly regions, more time to choose in slower markets, less urgency, more options. Rates near the low 6% range are definitely helping buyers re-enter the home ownership arena. Wins with terms. So ask for credits, repairs, or rate buy downs. There's definitely some leverage to take advantage of if you are a buyer. And focus on value pockets where inventory is building. Again, so important to work with a credible real estate professional who can assist you. Investors, national stability equals regional opportunity. Market selection definitely matters. Know the numbers. South and parts of the West may offer better discounts and concessions right now. Inventory growth markets can mean softer pricing plus better entry points. Returns matter more than appreciation in this phase of the cycle. Repositioning window, trim underperformers and optimize your portfolio. It is essential. These are business assets if you're an investor, and you want to make sure you're treating your investment properties as a business. So know the numbers, the cap rates, the cash on cash return. If you need any assistance with that, that's what my team does. And then underwrite conservatively, rent, insurance, taxes, and vacancy. Everything needs to factor into the numbers you're looking at. What happened to mortgage rates today? Well, mortgage rates moved 0.03% higher today. On almost any other day, this would be a bit of a bummer, but in today's case, it's a victory. So our 30-year fixed sitting at 6.14%, 15-year at 5.71%, 30-year jumbo at 6.3. Our 30-year FHA and VA are both under 6%. So there was a lot of potential volatility in the underlying bond market heading into the day due to the scheduled release of the big monthly jobs report. In addition, rates had taken a bit of an anticipatory lead off ahead of the data, or at least it looked that way. So the implication was that a strong jobs report would come as a surprise and require rapid correction toward higher rates, possibly significantly higher. Truth has been stranger than fiction. The job count crushed expectations and the unemployment rate fell to the lowest level since September. These numbers should have caused more damage than they did, i.e., we would not have been surprised to see mortgage rates jump twice as fast as they did at the very least. And what accounts for this welcome display of defiance? That's unclear. It's a phenomenon that's playing out in the broader bond market and not just in the world of mortgage-backed bonds. Either way, we'll take it. So that's from Mortgage News Daily, and this is verbatim from their website. So on our smart money insight, what this means to you at that national level. Don't follow the national market. Follow your market. Be aware of what's happening on the national market, but real estate is local and always will be. To Americas, we definitely have tight markets in the Northeast and the Midwest and very negotiable markets in the South. Price plus time on market tell the truth about leverage. Always has. Plan moves proactively while conditions are stable, not in a rush. So really take advantage. This is a great opportunity to review your portfolio, develop a real estate plan, a real estate wealth building plan that we can assist you with. Homeowners, protect equity with smart timing and pricing. Buyers, negotiate confidently where inventory is rising. Again, it's a supply and demand. If we start seeing that inventory is dropping, it means that buyer demand is increasing, fewer homes on the market, multiple offers, prices are going to go up, and then buyers lose the leverage. Investors, prioritize performance, cash flow plus risk over the hype. It's all in the numbers, as they say. Our local market spotlight, looking at Portland, our market action index of 40 remains unchanged for a slight seller's advantage. Median list price up slightly, $624,900. Price per square foot up slightly, $320. Inventory down, 935 homes, and median days on market is down to 91. So this is a buy the right house, not the headline market. Well-priced homes, especially mid-tier, will sell. Buyers should negotiate on overpriced listings, and sellers should price to the comps, not to the peak. Basically, price ahead of the market, and that's how you're going to maximize your opportunities. Lake Oswego, our slight seller's advantage up to 36 for our market action index. Median list price up to 1.5 million. Price per square foot down slightly, 479. Inventory is down to 109 homes. Median days on market unchanged at 119. This is a two-speed market. Premium luxury needs perfect condition plus perfect pricing. So it needs perfect condition and perfect pricing for premium luxury. Strongest players often in the 800,000 to the 1.1 million range, where buyers feel value and homes absorb faster. And Beaverton, our slight seller's advantage up to 43 for their market action index. Median list price down to 612.5. Price per square foot up to 295. Inventory has come down to 180 homes, and our median days on market has remained unchanged at 77. And okay, now I apologize. I've got the Smart Money Insight in there for Hillsboro, so ignore that information at the bottom. But basically, Beaverton is one of those markets that is the hottest market. Buyers see the value of being in Beaverton. Sellers still need to price aggressively. We will put the Beaverton numbers in our social media. Our neighborhood deep dives, watch your feed for Hillsboro, Tigard, Tualatin, and West Linn. Global perspective, I thought it was a good time to have a look at our neighbors in Canada and understand why international money is looking at Canada and it's because of its stability. So there's rate relief tailwind. Easing monetary policy is improving mortgage affordability and buyer confidence. Investor safe haven, Canada is emerging as a stability play amid global economic uncertainty. Now, you've got to keep in mind there is still chronic supply constraints. The major metros, Toronto, Vancouver, and Calgary, continue to face long-term housing shortages. Population growth engines, strong immigration levels are supporting housing demand and rental absorption. So there's, the pros and cons depending on what your goal is to consider investing in Canada. Resilient rental market. Tight rental supply is keeping upward pressure on rents in key urban centers. Construction lag. Development remains below what's needed to fully close the housing gap. So supply versus demand. Here's Economics 101 playing out in Canada. Global capital interests. International investors continue viewing Canada as a transparent, rule of law market. Definitely food for thought. So our global perspective, Canada isn't the fastest growing real estate market, but it may be one of the most defensive and durable. In a world of volatility, markets with population growth, supply constraints, and policy stability tend to outperform over the long term. Definitely reach out if you are considering changing your global real estate portfolio, or you'd like to expand and actually add a global perspective and add some global properties into your portfolio. I have a lot of Keller Williams partners in Canada who we would work together with them to help you achieve your goals. And speaking about wealth building using real estate, I thought I would share some information I obtained from a National Association of Realtors report, which came out this week. And then we summarized it into the wealth building insight for homeowners and then the wealth building insight for investors. So why should you own a home? So your home is still building wealth. 73% of US metro markets posted year-over-year price growth. Most homeowners are still gaining equity. That's always a good thing to hear. 147,000 in new wealth, actually. The average homeowner has built 147,000 in housing wealth over the last 5 years. Not a bad return. Price growth is slowing, but it's not reversing. Slower appreciation creates stability, not loss. And it's ideal for planning, not for panic. Affordability is improving with mortgage payments that are down 5.7% from last quarter, easing pressure for move-up and downsizing decisions. So generally, the real estate market is starting to move again, which we are so grateful for. Regional resilience. The Northeast and Midwest continue to show steady growth, ideal for long-term equity preservation. For investors, market shifts create opportunities for sure. About 25% of markets saw price declines, especially in high supply areas, which is ideal for repositioning their capital. Get in now before the spring markets come and everything starts going on the up again. Equity does not always equal performance. Appreciation alone doesn't mean your property is performing well. Cash flow and efficiency matter more now. So important. Treat your investment properties as a business asset and know the numbers. Reassess those numbers on a regular basis. And we're definitely here to assist you with that. So rents, rates, and reality check. With moderating prices and improved affordability, now is the time to reassess cap rates and returns, those cash-on-cash returns. Still pockets of strong growth. Some metros are posting 8 to 13% annual gains, proving opportunity still exists with the right strategy. And there again, you want to work and have on your team a real estate wealth advisor like myself. We are connected to other real estate wealth advisors across the country and are fully aware of where those pockets of opportunity are, because that's what we're doing. We're calculating cap rates, we're calculating cash-on-cash returns in our own local markets, and then we share that amongst our group. So passive is kind of gaining popularity over active for many investors. Investors are increasingly exchanging management-heavy properties for more predictable income options. After a while, you get tired of those 3 a.m. phone calls about the plumbing, the whatever. So, our smart money insight, what this really means for you. Equity creates choices. So, whether you own a home or an investment property, growing equity gives you options, but only if you plan ahead. Develop a real estate wealth building plan, and we're here to help you with that together with your financial advisor, your CPA, and whoever on your legal team you like to have involved. Now is a planning window. Slowing appreciation and improved affordability equals a strategic moment, not a reactive one. A more balanced, boring market is what we've needed for a number of years, and that's where we are, and that's how you can really be strategic with your real estate plan. Ask the smart questions. Is my property still working for me? Is my equity aligned with my long-term goals? Am I building convenience, income, or legacy? Smart money plans, it doesn't guess. So the most successful homeowners and investors review performance, reduce risk, and plan proactively. Legacy is built by design. Real estate wealth isn't just about owning property, it's about how and why you own it. And it's all about that strategy. So, as a real estate wealth advisor, we help people grow, protect, and transfer generational wealth. And the way we do that is we develop a real estate plan. So, let's talk strategy. And whether it's having a look at your primary residence or your investment properties, we would be so honored to do that and craft your 2026 real estate wealth plan together with you. Anything else that we discussed that sparked questions or inspired a next step, please reach out and connect. Always honored to assist you. And that quick disclaimer that the information we provide is for general information purposes only and should not be construed as investment, tax, or legal advice. We do obtain our information from very credible sources, obtained today, it's up to date, but we can never guarantee or warranty the accuracy or completeness or the results from using this. And you should always consult with your own legal, financial, and tax advisor and verify all the information to your satisfaction prior to taking any action. And that's why we like to work together with your team. And together we assist you achieve your goals. And with that, thank you so much for joining me. Hopefully you can get out, enjoy those last remaining rays of sunshine. And I look forward to seeing you next Wednesday at the same time for your midweek market brief for the Portland metro area.